Hello everyone, welcome back to another video. In today's video, we're going to discuss something different. As in, I mean, we generally discuss what the market has been doing and various ways we can use to decipher it or take trades. So, in this one, we're going to discuss something about options and how we can use it to effectively, I mean, use them so that if our views play out, we get something out of it. So this is going to be not only intraday but something on the base of uh, for a holding period of maybe 1 2 days and so on. So this is the main idea is to discuss something other than the strangles and the straddles we are aware of. So for all those who are not aware, actually they're quite popular these days, the strangles and the straddles. Straddles and strangles are nothing. For example, you have a daily chart over here and you're looking at the expiry next Thursday, that is on the 19th of October. So what you do is you sell the call options, for example, of 20,000. You're expecting this not to break, and you sell the call options of maybe 19,200 depending on the premiums. I'm sorry, 19,300 depending on the premiums. Now, a lot of times what we tend to do, or the mistakes that we do, or rather what I have also done in my initial few years, is just looking at the premiums and selling strangles, not looking at what the market is doing at the moment or whether it is conducive to strangles. So now that we have expiries almost every day, trading strangles is becoming a little more difficult, wherein the premiums do fluctuate a little up and down, and some also, like what I have come to realize over the years, that fretting over, that's my style. It is not to say that strangles are easy for or strangles are easy, but to fret over for 2 to 4 points or maybe 8 points of premium is too much for me to handle. And so what I decided some time back is I will go for what I'm comfortable with. So for me, strangles become a little more difficult than the directional trading, or even if I'm expecting a range, how to play out that range using options is what I prefer. So we will not talk about strangles and straddles as such, but we will go deeper into how we can use options to play more effectively if it suits you. So for example, if the present day chart, if I'm looking over here and for example, if I see the price come here and I see that this is not going to go any down any further, we'll just discuss why we would think that, and it might just bounce off here and go back and test this gap up at 19,900. So how can we play that? Let it be in a day or two, but we're expecting it to happen before this expiry. So I'll just go on and move to the strategy options desk that we have on Go Charting. So this is the options desk. This is the strategy chart. We'll discuss it sometime later. So we'll straight away go to the options chain, or rather the strategy builder, and from there we can start off with any strategy. So for example, if you have a long bias, we'll go both sides. For example, we'll discuss if the market is to move long from here, how do we play it, and then we'll go on to the charts and then decide how do we choose our strategies and where to go, or where to enter and where to exit. So the first thing is, what I will do is I'll make a custom strategy. So if, for example, we decided to go long, now there are two ways of doing it. You would have heard about it: the credit spread and a debit spread. The credit spread is nothing but you have the bigger position. For example, I'll just make one. So you're expecting the market to go up. So what you do is, for example, what I try to do is, if I am expecting 19,900 to be tested within this expiry, what I'll do is, if I'm looking for a credit spread, I'll sell 19,700 put, and depending on my risk appetite, I'll take a hedge of approximately 400 points or 300 points. Let's say 300 points, and you want to be really risk averse in this. So this is the payoff chart that you see. So for people who are new, this is nothing fancy. So what we see here is the projected PNL, that is, if on expiry, if we expire here itself and we don't move anywhere else, we're going to incur a loss about minus 250, 150. That's fine. Now you don't have to go only by what will happen if the market stays there. The market is not going to stay here. You have to be confident about what you're looking for. What you're looking for is a touch of this 19,900. That is why we selected the put option, which we have sold. So we have sold in the money for all those again who are new. So the premiums were high, and the risk to reward over here we'll see is the maximum I mean, if you go below 19,600, the maximum loss that you incur is about minus 7,900. This is with one lot, mind you, and the maximum profit that you incur is 7,100. So the risk reward is skewed in the sense that even if you decide, if you're not disciplined, you decide not to do anything about it, and you just let it leave, the maximum loss you incur is about 7,900 against the maximum profit that you incur, that is 7,100. So it is about in favor of, not in favor of the reward. So you'd say 0.9 is the risk to reward. Now moving on, what I would do is not leave it here. So what I generally like to do is take out some debit that I have given. So for example, I have left something on the table on this side. So what I would see is I have taken a hedge of 19,500, let's see, 600. Okay, so what I would like to do is I know that I'll go back to my charts, and now let's go to the charts, okay, and see what we are expecting and why are we choosing this position if we are going long, that is. Now this is a volume profile chart, and I have drawn some anchored VWAPs. Again, this has been discussed in the past videos from the recent pullback lows, that is 19,375, 360 level, from where we've seen a good substantial up move, and this is a small pullback. So even though this was a gap down, this is not still too much negative, because we are still above the anchored VWAP, that is about 660, 670 levels. So after this, if we break this down, is when we suppose we are already in the long, is when we start not worrying as such, but we start off I mean taking off the position. And if we start trading up below this and we go up to 600 or below 600, then is where we can square it off. And even I mean, with this strategy, it's not that you're going to be really in loss. So if you can just go back and see on your chart, for example, we get the what if on. So this is the what if analysis. So Monday would be 4 days left to expiry. So even if the spot expires somewhere close to 600 or something like that, so your PNL at that date would be about 2,400. That is the worst case scenario. Let's go over here, 600. So let's say 3,000. Okay, now let's get back to the chart. Now this is if you have entered and the position goes against you, that is if we go below 600, that is this place. Okay, so now what I would like to do is for me to reduce my debit is that I am somewhat not sure, but I think in my bias that we will hold this low, or this VPOC that we have here. That is, I think that we are going to hold this VPOC, because this was a major move with good volumes and it broke out. The other one was this volume, and it has held itself even twice now, and even this one was very high volumes, and they both have held. So what I think is we might not break 19,500 in this expiry. This is what I'm trying to build at. Now what I do is I will just go down a level below, and this is another POC which acts as a hedge for me, and I will go and I will add another let's go back to this, and what I will do is I will go to 19,400 and I'll try to reduce my debit that I've paid. So I will go and sell this, and a hedge for this will be somewhere close to 19,000. So I buy this. Okay, so now the payoff graph looks something like this. So the maximum PNL that let me see what I've done here. So I have sold I'm sorry, we will add something else also later. So what we've done is we've added some sort of credit, and we'll go and make this as 2 lots. So what I've done is I've effectively reduced my I mean expiry loss to about 6,800 effectively, and I have increased my profit by a little bit. So now if you see, even if the spot expires here, I'm in profit. Now that is inconsequential. And as I said over here, this is on Monday. So if on Monday we keep going down and we break 6,000, so the PNL at this point over here would be somewhere close to 4,000. Now this is because the puts over here will also keep growing with time. Now at this point there are two things that you can do. Either you are confident in your analysis, or you just shift this 400 even behind, looking at the premiums what that point in time is. Now I'll get back to this, how you can avoid this as well. Now this is a payoff structure that we look at, and if in case we do go up and we do hit, let's say 17,900 that we are targeting by let's say Tuesday, and we go and hit I'm sorry 19,900, which is somewhere here. So what we get is by the end of Tuesday somewhere close to 5,100 or 200, and if you prefer you can wait. Again, you can shift your the put strikes that you had at 400 further up, or not do anything depending on what your risk appetite is. Now coming on to why will I shift behind, or should I shift behind or not, or should I just square off? It depends on you. What I like to do is when I enter something like this, let's go back to the volume profile charts. I would not like to enter here, so that my risk reward is in favor. I will not like to enter into directional trades or a move that I'm expecting. If you look at it, why was I targeting 19,900 is because there is a gap which I think can be filled, which is somewhere close to this place, and the attempt has been made twice. If you know market profile, this is some sort of a weak high, and there was an attempt to fill a gap over here. So we might attempt and touch this place before any further move is what we hope for, or is what we are trading. Now I wouldn't enter at this point. Why? Because it is in the middle. It's not giving me a good risk to reward. So my reward, rather I would have preferred to have my risk at least over here. So 600 it should be close, and this is what we discussed, is this point is what we expect to hold 19,500. So I would have preferred to enter somewhere either when we opened here with a gap down, or somewhere close to, if we get a chance, close to this VWAP, that is somewhere close to 650, so that my risk reward is favorable for me. And I would come out if it breaks 19,500. I will not wait till expiry. If we touch here or we try and break this, I'm sure we're going to test this zone, so I will not stay there. What I will look then for is another way of getting going into the short side. As of now, if I'm planning a long bias, I have just discussed how to go about it and how to plan your trade using options. Now the other way to do it is, I'll just go back to the payoff builder. The other way to do it is, this is primarily we have been selling options, and we have our hedges are always been the options that we have bought. The other way to do it is, I'll just clear everything over here, and we will start another. Other way to do it is cancel. Let's go back to positions and delete everything. Okay, so the other way to do it is we will go, let's say long bias, and this time we will have what we'll do is we will have the options that are that we buy as the the primary the ones that we are expecting to go up in value. So we'll just delete this. I don't know. Okay, so now we will add one more, and let's say long. Okay, so we go here and we add a leg. Now what I mean to say is, now we're expecting 19,900, that this is the call. So what we'll do is, suppose we are 19,750, we'll buy this one, and we will, again, our hedge would be somewhere close to 2,000 like we did over there. We will sell this one. Now what has happened is, straight away the skew is towards the to the side that you are hoping will work out. So you see the maximum loss that you incur is 5367, and the maximum profit is much more. It is 1:1.5, 1:2. The problem here is that if it stays here, for example, for a long time, people think that you don't get profit, but this going long with hedges can be played very, very intelligently. We'll just discuss that. So let's go back to 6 days to expiry. Now this is what we're expecting. If the market expires here, we are going to lose 2,700. Now this is the drawback of going long, or a debit spread as we call it. Now similarly, if we just play out the view that we just played, and we say that 19,400 is something that we don't expect to break, and we go in and add another, we just reduce the debit that we have here. So we go and add a 19,000. There are two ways to do it. You add a 19,400, or what I would do is go on the call side, and firstly I would say that since we have added a hedge of 20,000, and I expect that 20,100 may not break. So one way to do it is you just sell these open options, and the hedge can be really far off like this. So you get 3-4 rupees credit over here, and or even 20,300, and this is the payoff graph that it looks now. And you can go ahead, like we just discussed, go ahead and increase the size of this. So now what happens is suddenly I have even if it expires here, what I have come down to is a little, 500-600 rupees credit is that I pay is lesser. And if for example by the time, for example, that we were expecting by Tuesday, we reach 19,900, for example, over here, the amount you get over here is somewhere similar, that is 4,800, a little bit lesser. Now another thing that you can do here in this credit spread is debit spread is, the advantage that this debit spread has is that you're not going to lose much even if you are not disciplined. That is one. Like we just discussed, you're losing about 70% of what you would be losing if you had gone for a credit spread in the previous example. And the other thing that we would like also to add some reduce some debit is, like we discussed, I also do not expect the markets to go below 19,400, so I will just add that hedge as well. And you can see straight away what I have is another 500 points deduction in my premium. And now if the premium expire on the same day, I have drastically reduced my profit loss. So if the market is to expire at the same place, now I've come down to almost 1,800 to 1,900 rupees. And if we go and touch 19,900, we will get a lot more. So we'll get about 5,100, 200, that is about 300 points per lot extra. And what we have not done is we'll just go and add 2 lots of this also over here, and now you can see the spread looks much better. So the maximum loss that you incur on this particular strategy is, if let's go back on Monday. If on Monday for example you go and like we've said, we will start to panic below 17,600, that is 500 and 600. So even if we reach 500 on that day, we'll be about 6,000 negative. Now if something like that starts happening, you start shifting your calls below, and you should start 600 is your level that we discussed, where you should start thinking of what to do next, and adjusting your payoff graph in such a manner. So the advantage with going with the credit spread, debit spread, is that you will have a lot of options. You can actually use options to adjust yourself and minimize your losses. What I mean to say is, you can just shift the puts behind if you see something like this, because the premiums would have shot up, and you can shift the calls back up, so the payoff graph keeps shifting to the left side, and even if it is not moving in your favor, the losses are minimized. So you keep doing that, and if you see the 1 sigma moves on the downside are covered to a lot of extent. So a 1 sigma move to the upside would give you almost, if on Monday, or let's say Tuesday, a 1 sigma move to the upside on Tuesday would give you somewhere close to 7,300. That's a lot. And on Tuesday by end, it will give you a 5,800 loss if you are on the other side of the 1 sigma move, that is close to 19,500. So 2,250 points up and would give you a loss of 5,700, whereas a 150 point move up would give you a significant profit, that is close to 6,300. So you can play all this, and it becomes a lot easier to keep adjusting your positions when you're going in for a debit spread. In a credit spread where you have sold primarily the bigger options, it becomes a little difficult. Not that it is difficult, but it is easier to manage these plays. Again, it is according to your risk appetite. My job here was to show both sides, and both of them work very well depending on the markets that we are having. Now the last thing I want to show is why wouldn't I enter here at this point, is because firstly the weekend was coming and maybe I would have entered somewhere lower. Let's go to the profile charts. Now I would have preferred to enter during the open over here, is because firstly I was expecting, as I discussed, my stop losses would have been a lot lesser over here during the open or this D period, wherever, because this was a gap that that we hoped this up move and this pullback would hold. The maximum that we expect over here is 640 and 650 levels to hold because of this single print, and there have been substantial up move after this. And this, when we saw in the volume profile charts as well, I will just go back over there so that you can see it over here, is this. So this you can see these 500 levels, and this one is what I'm talking about. It held to a great extent and we saw a good move on the upside. And there's a low volume node, if you see over here at 650, let me delete this, is what I am banking on. Like in market profile charts, I will just show you here. This low volume node, if you expand, is what I am banking on. This is 650 levels. So I would have preferred an entry somewhere here so that my stop loss would have been defined, and I have an anchored VWAP also to support in the same region. Another thing that I have in my favor is, I will just go into the daily charts, and what a lot of people and institutions are looking at is let's take out all EMAs, and this is another way to look at where your, the recent wherever you're taking these credit spreads. That is, we decided to take a 19,400 spread because we thought we're going to defend this. I'll just show you the charts over here. So if you see, we have taken these 19,400 puts that we have sold over here. This was also because of a reason. We just didn't do it randomly. We did it because we are expecting this 19,400, or rather even before that, to hold, because there is a 100 EMA coming and there is a gap, and this particular candle is what we expect to hold. If we go back to the profile charts, we will see something similar over here. So as we just discussed a little time back, this is what we are expecting to hold, 420. That is why we have sold 400 options over here, because we don't expect this and this even 550 to break as of now. Okay, if it changes, we can adjust. As we discussed, in a debit spread, it's easier to adjust and we can keep shifting so that we can minimize our losses. Or the simple way is you can just move out of the trade and plan another one. Now the last one, let's go back to the market profile charts and look at the market profile where we expect. So this is the same level. It's there in the volume profile, the low volume profile node, in the daily chart, not in the daily chart but in the volume profile and market profile. We expect some sort of resistance over here, and the next target that we have is this one, which we're expecting to hold. And obviously this POC is what we were discussing, is that this should not break, and below which we have sold our puts. So this is how you can actually plan your trades and options. If you find this interesting, we will discuss more of such type of option strategies in the coming few videos. Until next time, bye bye. Thank you.